Alrighty, I'm just conscious of time, so I think I might kick off, and then anyone that comes in will be able to jump on the recording or pick it up. Firstly, thank you to everyone for jumping on. For those that don't know, my name is Joe Harding. I'm the Startup Advisor and Accelerator Lead here at Hyper. Start off with a little bit of housekeeping. Feel free to pop any questions in the chat. We'll try and make time at the end to go through as many as possible, but if not, myself and Jack will be able to pick them up at the end. Thrilled to have Jack from FullStack Advisory with us today. I've had the pleasure of working with Jack for a couple of years now, both my previous role and here at Hyper. I'll let Jack do a quick intro and let's kick it off.
Cool, yeah, so thanks Joe and thanks Hyper. Really excited to be part of the community and have the opportunity to present to everyone today. I'm the R&D tax manager at a company called FullStack Advisory. We're a chartered accounting firm specializing in startups, entrepreneurs, that kind of thing. So we're a bit of a startup ourselves, and we really understand all the kind of pain points for startups, and that's really where we've tried to find our niche. So today is just kind of an introduction to R&D tax and grants. This slide deck is quite long. There's a lot of information. There's a lot of words on the screen, which I won't read. I will be probably skipping through a fair bit of it. But the idea is hopefully everyone gets, at least one incentive or grant or piece of information that's new and that's helpful. And then you'll have the slides to refer to at the end with all the lists of grants and things like that. So as Joe said, happy to take questions as we go, but generally there are quite a lot, so I've tried to leave plenty of time to the end, so we can go through anything. So may as well kick off. This is not advice at this stage. You should always obviously speak to a consultant or accountant or lawyer around your personal situation. That's me. Already gone over that. So the agenda for today is going to spend a little bit of time on the R&D tax incentive, and then I will give a bit of a grant snapshot. I'll give some details about some specific grants, but I talk about grants more kind of broadly because there are many grants, thousands of grants. So I don't necessarily like to focus too much on specific ones. And then we'll talk about the early stage innovation company concessions, or ESIC. If you're not already aware of that, then that's definitely something that's probably applicable for most people here today. So at FullStack, we like to kind of look at government grants, incentives as part of, as a complementary piece of the funding strategy. And that gives you a bit of a timeline. So the R&D tax incentive is the early one. Then you might get a grant after that, the export market, when you start exporting, and then the accelerating commercialization. So it's just about kind of knowing where you are in that timeline and acting accordingly. So R&D tax is the Australian government's flagship program to incentivise experimental research and development activities being conducted in Australia. So the program in various iterations has been running for a very long time, and it is the primary funding strategy rather than grants to assist companies in that very early stage of research and development. So the for companies with less than $20 million turnover, groups turnover, aggregated turnover, the current value of the offset is an R&D premium of 18.5% above the company tax rate. So most people in here, that will be 43.5%, 25% plus 18.5%. The offset is refundable. So what that means is if you're tax paying, you reduce your taxes until they're zero, and then anything else is available as a refund, as a cash refund. So for startups, generally with R&D expenditure of less than their total loss for the year, then they would receive back the full 43.5% of their R&D expenditure as a cash refund. That refund will be reduced as you move into a more profitable position. And then if you're a fully tax-paying company, you don't have any losses to use, then you essentially pay 18.5% of your R&D expenditure less tax. So the kind of net benefit over the lifetime of the company of the R&D is 18.5%, but the refundable aspect gives a massive timing benefit, which is very useful. So we have in the R&D tax a thing called core R&D activities. So that's really what we're looking for in terms of those activities that are eligible. These are experimental activities that are in an area of established science. So that could be, the traditional physics, chemistry, maths, engineering, those kinds of things, but also obviously information and communication technologies, software is an area of established science. You must be conducting your activities in a systematic fashion. So following this scientific method, that's where we talk about having a hypothesis, experimental steps, and logical results and conclusions. Core R&D activities must be conducted for the purpose of generating new knowledge. So that can be at the high level in the form of new or improved material, product, device, process, or service. It doesn't necessarily have to be the whole thing. It could be down to an individual algorithm, within a larger platform or something like that. You can also have multiple core activities. They can carry over for multiple years. You can start and stop. There's no requirement for them to ever be successful either. And then the final kind of component of the core R&D activity is that you must not be able, or the outcome could not have been known or determined in advance. So what would a competent professional in the particular field be able to achieve without also having to go through an experimental process of research and development?
Sorry to interrupt, Jack. Could you give a quick example of that for a tech-based business? Would it be like the developer note-taking or trialing? What would that look like for on the tech side?
For the outcome or for the core activity as a whole?
For the point for the outcome side.
Yeah, right. So generally how you establish that, so the test is that the outcome could not have been known or determined in advance on the basis of current knowledge, information, or experience. And some of the supplementary materials to the program talk about a thing called a competent professional. And there's no kind of set definition. It's just who is a competent professional in that particular field. So you may have people internal to the business that are competent professionals in that field. You may liaise with third parties to help you make that assessment. If you were to ever have to demonstrate to the tax office that you took those steps, then you might show them emails or meeting minutes or notes or more formalized kind of reports around state-of-the-art searches, the technical unknowns. So generally, it's we want to build something that does this, this, and this. We had a look at what was already in the market. We looked at open source code repositories. We consulted with developer forums. We internally are competent professionals, and we established that there was a technical knowledge gap, a technical knowledge gap in this particular area. So we thought that if we built an algorithm based on these principles, it would have the technical functionality that we need to the standards, but on the basis of what's out there, on the basis of our internal knowledge, we didn't know whether it would actually meet those requirements unless we go through that process of design, development, test.
Okay, brilliant. Thanks, mate.
So that one's really important, especially in software where often we're using a lot of third-party tools and technologies and things like that. So you need to show where that knowledge gap lies. So generally, we talk about Australian-based activities. So if you have developers overseas, most likely you won't be able to claim those. There are some exceptions or if there is one exception, and that is if you can show that the expertise was not available in Australia. And that will involve submitting an overseas finding to show that to the ATO, and then they would, if you were able to demonstrate that, then they would provide you with a certificate saying you could claim those overseas activities. So Australian-based activities are where a person is physically located at the time that they were conducting the activity. So it doesn't matter where the company is headquartered, or what company you make the invoice out to. It's just, are those people physically in Australia? There's a few other things. There's a minimum spend of $20,000 per year. So this is a yearly process. The activities, you can only claim activities conducted on behalf of the company, of the claiming entity. So you can claim activities done by subcontractors for you. But if you were subcontracting to another company, they would be the claimant rather than you, generally. You must have a corporate structure, so always good to set up a company as early as possible, and the expenditure must be at risk. So if someone is paying you to do a specific activity, then you just need to make sure that you need to determine whether that expenditure is at risk. The broad expenditure categories that you can claim are contractors' salaries and wages. That typically accounts for kind of 90-95% of costs. You can also claim decline in value, so depreciation, the cost of assets purchased for use in those R&D activities, and other directly related expenses. So the main ones there are subscriptions, consumables, travel, overheads, etc. Payments to associates, that's an important one. So generally we use accrual-based methods for tax. So when you incur a cost, you include it. You are able to include it in the R&D. The one exception to that is payments to associates. So if you incur an amount to an associate, like a founder, you must make sure that those amounts are actually paid prior to the end of the financial year. Otherwise, you won't be able to claim them. There are also some excluded core R&D activities. That list there is not is just a sample. There are some. There is a larger list, but that's probably most applicable to the people here today. So research in the social sciences, arts and humanities, that's an interesting one, because you really do need to be working in an area of technical, scientific, like a real kind of traditional science rather than a social science. There's just an example there about the kind of blurs the line between something that is software development, but also kind of in the healthcare space. So you might have activities that are based in kind of health sciences and also based in communication technologies software. Project scoping, so you can group core and supporting activities into projects. Supporting activities are activities that support a core R&D activity but are not core R&D activities themselves. So typically things like data collection, development of supporting infrastructure, so not the real interesting things, but things around that are needed to be able to do those core R&D activities, project management, administration potentially, as well as project resources. So it is self-assessment. It is up to the company to determine what activities are eligible and costs. Obviously, a consultant such as myself can assist with that. There is a misconception, I think, a lot of the time, is that when you receive your refund, that means that someone from the government has approved, ticked a box saying, yes, you are doing R&D. That's not the case. It's self-assessment. So any audits or reviews typically will come 3 to 5 years down the track. So it's really important to make sure that you are obviously compliant and you keep records to assist you in the event of an audit or a review. You have 10 months after the end of the year to financial year to register your activities. So if there is anyone that has not yet registered for the 22 financial year, then you should think about doing that as soon as possible, because the deadline is the 2nd of May, 2023. this slide is just to kind of make the point that R&D tax is a very specific thing that is a bit different to research and development more broadly, how people generally talk about it. So the R&D tax is really about that kind of scientific area. Your kind of general R&D and commercialization activity will probably, may contain eligible R&D, but it's generally not good to like claim the whole product development, everything. I won't go through that. There's the record keeping requirements. That's just kind of in there for your reference to look at later. And then the biggest kind of tip I could give anyone is to do this in real time. So it's always better to do it in year rather than retrospectively, because where most people will fail a review is not because they haven't done R&D. It's because they can't show that they've done R&D as per the requirements. So you really need to keep those records. R&D finance. So this is a really, this is quite a new product that's becoming more, much more used by a lot of my clients and people out there doing R&D. Basically what it does, because generally you have to wait until the end of the financial year, you submit your form, and then it might be another 2 to 6 weeks before the refund is received. R&D finance is a product from finance providers that will give you, or they will loan you a portion of the R&D offset that you will receive at the end of the year. But what it does, it allows you to bring costs forward. So if I was, spending 100K in this current financial year, if I've already spent that, but I need more funding, then I can get a loan from one of those finance providers, spend it in this year as well. That actually will then boost my claim at the end of the year, and then I use the refund to pay back pay off the loan. So you can actually bring forward those expenses and potentially accelerate your commercialization. When you're doing R&D finance, it's really important to make sure that you are getting that refund, obviously. So when you're doing that thing, you need to take into account the potential of getting grants or income that will reduce your total refund. So grants. Going to really quickly race through these. So there's just a couple of slides of kind of the major areas of grants in Australia, both at the federal and state level. So CSIRO and the Entrepreneurs Program have a lot of programs to assist you with research. So they'll get researchers from CSIRO to come and work on your business, your R&D, or you might get a graduate or a researcher from a university or something like that to come into your business and do work, or you might send one of your staff to the university to get more skilled. The accelerated commercialization, the one down there at the bottom, is the federal government's kind of biggest thing for commercialization. So typically you would do your R&D and then you would look at the accelerating commercialization project. Although the long-term future of that program is currently under review. So just keep that in mind. The MVP Ventures program is in New South Wales. That's a really good one. It used to be $25,000, maximum of $25,000. They've quite recently relaunched that program, so it's now up to $200,000 match funding. Pretty much all of these are match funding. I'll go into that a bit more in a bit more detail. But if you see matched and there's no percentage, then it's 50-50 for all of these. So the MVP will kind of take your kind of early prototype and kind of attempt to commercialize it. There are a few other states have their own kind of similar programs. Queensland has Ignite Ideas. There's an Innovation Booster grant in WA. These are all different amounts, different timelines, different percentages of match funding, different criteria. So I'm not going to go through it all in this presentation, but I will go through some kind of more general criteria to keep in mind. So defense, there's a lot of ones out there for specific industries, defense, transport, manufacturing, ag tech, things like that, that are national priorities or state priorities. They'll often have their own programs. There's also the Boosting Female Founders there at the bottom, which is currently closed. I think they'll probably relaunch that. Sorry?
That's what I was going to ask, if you knew who it was relaunching.
No, I think, yeah, it's very popular. So it was almost too popular. There was quite a bit of negative press around the earlier rounds, just because the small percentage of people who actually receive those grants. So that's probably something that they are looking at as well.
Yeah.
At the moment, the new federal government is doing a lot of rolling out the National Reconstruction Fund. So it's a lot of kind of manufacturing, lots of infrastructure, lots of grants around transitioning our clean energy future, things like that. The Export Market Development Grant is also a good one. So this is a bit more entitlement. A lot of those other ones on those other slides are more kind of competitive. So you're competing against other companies for a set pool of funding. The Export Market Development Grant is more akin to the R&D tax incentive in terms of if you qualify, then you will receive some amount of money. They have actually reduced the funding for this quite a bit. Well, they kind of relaunched the program, and as a result, a lot more people are eligible. So the total amount that each company gets has been reduced, but up to $28,000 per year potentially. Is useful. So that covers things like consultants' promotional advertising material. That can include things like Google Ads, Instagram, LinkedIn, all those kinds of things as well. So these kinds of grants are all generally about funding specific projects. So when you are looking at the grants that are out there and to see whether you're whether they're applicable to you, you really need to have a firm understanding of what your project is. A project that's kind of ready to go, but the only reason why you haven't started is because you've only been able to raise half the funding required. And that's when the government kind of steps in as a funder of last resort a lot of the time. So as an example project for these kind of commercialization, these grants that focus on the kind of commercialization, it might be to take an R&D prototype through to a finished kind of product. So you've already shown that it works from an R&D perspective, but now you need to put some polish on it, integrate with a partner system, maybe develop another module or something, and then test that with generally a third party who, you might do a proof of concept for 6 to 12 months. And then if it's successful, then they'll become your first customer. So just to pick something off the top of my head, if I'm developing some kind of property tech platform, that assists in the, let's just say finance, maybe fintech, prop tech kind of thing, I might partner with a real estate agency or real estate.com or something like that, and they would, use our technology, test it out with their users, and then if successful, then they'll kind of roll that out more fully. So generally, these kinds of grants will cover salaries for project personnel, contractor costs, prototyping, IP protection, travel, sometimes manufacturing plant, sometimes capital equipment. sometimes not. That's why it's in italics there. So the merit criteria. So I didn't go through the specific merit criteria for every grant on those other slides because it just would have taken too long. Here's a sample of the things that you have to demonstrate for these accelerating commercialization, ignite ideas, and MVP ventures. And you can kind of see that there is a lot of crossover. There's a lot of similarity between these. So it's all about generally showing that there's a market there, showing that you have a technology that is useful and that can fill that market, that you are ready to go, that you have the kind of team in place to execute on your ideas, that if you are funded, that there is a high chance of success. And then obviously the kind of arguing why you should get the grant. So what are the broader advantages of funding you over someone else? So it's around employment, boosting employment either in Australia or the specific states. It's by spillover effects of your technology. So, creating more innovation, more efficiency, that kind of thing. A lot of these grants will have specific sectors that get extra points as well. So often things like agriculture, medical technologies, defense technologies, things like that as well will get more because they're matters of national priority or state priority, they'll get additional points. So generally when I talk to people about grants, I say to them, you need a project. So you need a milestone table with specific, dates, length of activities, costs associated with those. And they can kind of be tailored to specific grants, but you really need to, start with the project and then see what grants are out there rather than see what grants are out there and then try and, tailor what you're doing to those grants. Sometimes chasing grants can be a bit of a time sink. It's better to kind of be ready. So have business plans up to date, have investor presentations up to date, all those kinds of things. And then if there's a grant that's suitable that comes online, then you can go, okay, that's, we should apply for that. And then really kind of, jump in and really try and smash it out. So these next two slides are a list of documents that you will most likely be required to provide for any of these grants, especially the more lucrative ones. So the project plan, you need a budget, milestone table. You need to demonstrate that your technology is innovative, that it is an advancement on what's already out there, that you have the means to protect as well your intellectual property. The grants that are matched funding as well, you need to demonstrate that you have half the funds or whatever the percentage is of matched funding. So commitments, money in the bank, very firm commitments and money in the bank generally. But then you also need to demonstrate that that you have tried to raise the other half of the funds, but you have not been successful. So they will require you to show that you have attempted to secure that finance from, financial institutions, VCs. So really what they're doing is stepping in as a funder of last resort because you've made such a compelling case that your project should be funded, that it would be, it would be silly for the government not to, because you're going to create jobs, you're going to increase export revenue, you're going to improve the base level of technology. Then there are all these other documents. So CVs of key personnel is important, as well as prior year financials. A lot of the grants will have turnover limits they will have employment limits, so less than 20 full-time employees or less than 50 or something like that. So you'll need to provide those financials. So the early stage innovation company concessions is the last kind of section before we get to questions. These are concessions for investors who are purchasing new shares in an early stage innovation company. And so you can see from this slide that they are very good. They're very valuable for investors. So 20% non-refundable tax offset. So if they invest $1 million in your company and they are a sophisticated investor, they will get a $200,000 tax offset. So that reduces their assessable income for the year. There's also a CGT-free window if they hold the shares for 12 months, at least 12 months, and sell them before 10 years is up, then they won't have to pay any capital gains on the proceeds of the sale of those shares. These are not generally available to founders, other affiliated parties. For employees, the shares are issued under an employee share scheme, or if the investment means that they own more than 30% of the shares. So there are two kind of halves to showing that you're an early stage innovation company. There is the early stage test and there is the innovation company test. This is the early stage test. So you can refer back to this slide and I won't go through it. The innovation test, there are two options to qualify under the innovation test. There's the 100-point innovation test, which if you meet one or more of these criteria, then you get the points. So a lot of companies in here will probably already qualify. A lot of people in here will probably already qualify on the basis of an accelerated program plus prior third-party investment of $50,000 or maybe a sufficiently large R&D claim. So the 50 points is for an R&D claim that is at least 25% of the total spend for the year, and the 75 points is for an R&D claim of 50% of the total expenses for the company. If you don't meet the 100 points based test, there is a principles based innovation test, which requires you to assess the company based on these 5 points. So it's a little bit more, I guess, subjective, you could argue. A few other things just on ESIC. So it is self-assessment. So you are required to provide a report at the end of the year with the qualifying investments. But no one there is no assessment made by the government at that point as to whether the company is an ESIC or not. You can ask the ATO to make a ruling as to whether you are an early stage innovation company. They will not do that on the 100 points based test. They'll only do that on the principles based test. There is a thing called the test time. So if an investor gets the concession, they need to make, or if they are issued shares, they need to make a test immediately after they were issued the shares to determine whether the company was an early stage innovation company at that point in time.
Yeah. Sorry to interrupt. Would so the founders going through Hypers Accelerate, when they're speaking to investors, be able to self-assess, say we are an ESIC company, and be able to speak to that based on the 100-point test to early stage investors, angels?
Yes. Yeah. So my experience is most of the VCs and angels they are sophisticated investors. They will be aware of these, and it certainly makes it more valuable. to them, so they will often ask you. There is an eligibility tool on the ATO website. That, if you just Google ESIC eligibility tool, then you can go through the 100 point space test there. A lot of the time, if you qualify on a 100 point space test, that will be enough for the investor. And sometimes you might provide an accountant's letter or a letter from a consultant that confirms on what basis you meet the 100 point space test and the early stage test. They're not so keen for self-assessment on the principles-based test generally. In that scenario, what they'll often do is ask the company to get a ruling from the ATO.
Okay, thank you.
So companies must report their qualifying investments to the ATO via an ESIC report, and the investors report through their tax return, whether that's the company tax return or the personal tax return. So this last point actually is very important. The test is made on the company that is receiving the investment, where the shares are issued. So in a structure that has a holding company and then a wholly owned operating entity that is actually doing the R&D, doing the commercialization, doing the development, in that instance, generally the holding company will not be an early stage innovation company because it's not actually doing anything. It's not developing anything. It's just holding the shares of the operating company. So some people sometimes get in the trap of thinking that the criteria is based on the group. It's not. So you really need to make sure that if you want your investors to get these concessions, that you kind of set up correctly and make sure that the company that is receiving the investment, that is issuing the shares, is the early stage innovation company. So that's the end of the presentation. I've probably gone a little bit over what I was planning, but we do have a few minutes for questions. That's just a little bit of other information about what FullStack does.